$200,000 every week, not every year, not every month, every single week, generated through a systematic, mathematically grounded Forex trading strategy that operates on principles most retail traders never encounter because they're too busy chasing signals and copying setups from people who don't actually trade. Now, before you dismiss that number as fantasy, stay with me, because this video is not about promising you $200,000 a week. It is about showing you the exact mathematical architecture that makes that number possible, what capital base it requires, what return percentages it demands, what risk framework it operates inside, and what the realistic developmental path looks like for a trader who wants to build toward a strategy of that scale. Understanding how elite-level Forex strategies are constructed mathematically changes how you think about every trade you place. Even if you're trading a $500 account today, the principles governing a $200,000 weekly strategy are the same principles that should govern yours. The math doesn't change with the zeros. The discipline doesn't change with the zeros. What changes is the base, and the base is built deliberately over time through a process. That process is what this video is about. Let's build the math from the ground up. What it actually takes to generate $200,000 per week. The first thing a serious trader does when they see a target number is reverse engineer it. Not dream about it, not dismiss it. Reverse engineer it. Work backward from the outcome to the inputs required. So let's do that. $200,000 per week, 52 weeks in a year. That's $10,400,000 annually in gross trading profit. Now, what return percentage does that represent, and on what capital base? This is where the math branches into two fundamentally different scenarios, and understanding the difference between them is critical. Scenario A, trading your own capital. If you are generating $200,000 weekly from your own capital, the question is, what account size makes that percentage return achievable without requiring reckless risk? Professional traders, the ones operating at institutional level with documented, consistent performance, target weekly returns in the range of 2% to 5% of account value. Not 50%, not 100%. 2 to 5% consistently, week after week, is what separates sustainable professional performance from lucky streaks. At 2% weekly return, required capital equals $10 million. At 3% weekly return, required capital equals $6,667,000. At 5% weekly return, required capital equals $4 million. These are the real numbers. A trader targeting $200,000 weekly at responsible risk levels needs between $4 million and $10 million in trading capital. That is not discouraging. It is clarifying. It tells you exactly what the capital accumulation target is, and it makes the developmental pathway concrete. Scenario B, trading managed or institutional capital. This is the scenario most people overlook, and it is the more realistic pathway for the majority of serious traders. A prop firm trader or hedge fund manager generating $200,000 weekly is not necessarily working with their own $4 million to $10 million. They are working with allocated capital, firm money, investor money, pooled accounts, in exchange for a performance fee or profit split. A trader managing $20 million in client capital at a modest 1% weekly return generates $200,000 weekly in gross profit. Their personal cut at a 20% performance fee standard in the fund management industry is $40,000 per week, still $2,080,000 annually, from a 1% weekly return on managed capital. This is the architecture that elite traders actually operate inside, not a $500 account with 500 to 1 leverage trying to turn $200,000 in a week. A serious capital base, serious risk management, and a consistent percentage return that scales with the base. Understanding which scenario you're building toward is the first strategic decision. Everything else, the strategy, the vehicles, the risk parameters, flows from that decision. The capital accumulation math, building the base that makes this possible. Whether you're targeting $4 million in personal trading capital or $20 million in managed capital, the base has to be built. It doesn't arrive. It is constructed, compounded, and scaled through a systematic process. Let's model that construction process from realistic starting points. Starting capital, $10,000. Target, $4 million. At 10% monthly return. a performance level achievable by disciplined traders with documented edge. Here is the timeline. Month 6, $17,716. Month 12, $31,384. Month 18, $55,599. Month 24, $98,497. 2 years in, still under $100,000. This is the desert. The stretch where the math is working but the numbers feel small and the temptation to force acceleration is at its most dangerous. Month 30, $174,494. Month 36, $309,129. Month 42, $547,737. Month 48, $970,418. 4 years, under $1 million. Still grinding, still executing, still protecting the base. Month 54, $1,719,474. Month 60, $3,045,885. Month 63, $4,061,647. 5 years and 3 months, from $10,000 to the capital base that generates $200,000 weekly at a 5% weekly return. Now, with capital additions, because a serious trader is not only compounding returns, they are adding capital from other income sources, from prop firm profits, from performance fees on managed accounts. If this trader adds $5,000 per month from external income sources throughout this journey, the same destination is reached in approximately 4 years and 6 months instead of 5 years and 3 months. The additions matter. The compounding does the heavy lifting. Both working together is the fastest legitimate path. Starting capital, $1,000. Target, $4 million. Same 10% monthly, same discipline, longer timeline. Month 36, $30,913. Month 48, $97,042. Month 60, $304,589. Month 72, $956,167. Month 78, $1,273,789. Month 84, $1,696,817. Month 96, $4,728,848. 8 years, from $1,000 to beyond the capital target. The starting amount changes the timeline. It does not change the destination, and it does not change the process. That is the mathematical truth that makes this framework available to almost any serious trader, regardless of their current capital position. The strategy architecture. What a $200,000 weekly strategy actually looks like. Now let's get inside the actual structure of a strategy operating at this level. Because most people imagine elite Forex trading as a frantic, screen-watching, split-second execution game. The reality is almost the opposite. Strategies generating consistent weekly returns at institutional capital levels are characterized by 3 things that retail traders systematically undervalue: selectivity, structure, and size management. Selectivity, the trade frequency paradox. A trader managing $5 million to $10 million does not place 50 trades per week. They may place 5. Sometimes 3, sometimes, in weeks where the market doesn't present setups that meet their criteria, 1 or 0. This is counterintuitive to retail traders who equate activity with productivity. But at high capital levels, the cost of a poor trade is not just the loss on that trade. It is the drag on the compounding engine. A 3% drawdown on a $5 million account is $150,000. Recovering from that loss requires a 3.09% gain just to break even. The asymmetry of drawdown recovery means that not trading is frequently the highest value decision available. Elite traders are not paid to trade. They are paid to be right, and being right requires waiting for the setups that meet every criterion before capital is deployed. Structure, the anatomy of an institutional grade trade. Every trade in a strategy of this caliber has 5 defined components before the order is placed. Entry trigger, the specific objective condition that initiates the trade, not a feeling, not a hunch, a defined technical or fundamental signal that the strategy has documented as historically preceding the target price movement. Position size, calculated from the account balance and the defined risk percentage per trade, typically 0.5% to 1% at this level. On a $5 million account at 0.5% risk, the maximum loss per trade is $25,000. The position size is calculated backward from the stop loss distance to ensure that if the stop is hit, exactly $25,000 and not a dollar more is lost. Stop loss, placed at the level where the thesis is definitively wrong, not where it hurts, not where it's comfortable, where the trade idea is invalid. This is the most technically demanding component of trade construction and the one retail traders most frequently get wrong. Take profit target, defined by the strategy's historical risk-to-reward ratio. A strategy with a documented 1-to-3 risk-to-reward ratio places the take profit at 3 times the distance of the stop loss. At $25,000 risk, the take profit targets $75,000 profit. If the win rate is 40%, which is low, the strategy is still highly profitable. Win rate is not the primary metric. Expected value per trade is. Invalidation condition, the specific market development that would cause the trader to close the position before the stop loss is hit. A news event, a structural break, a change in the market context that the original thesis depended on. Having this defined in advance removes the emotional decision-making from live trade management. These 5 components, defined before every trade, are what separate a strategy from a gamble. The strategy is a decision-making framework. The gamble is a hope with leverage attached. Size management, how position sizing scales with capital. At $500,000 in trading capital, a 1% risk trade is $5,000. At $2 million, it's $20,000. At $5 million, it's $50,000. The dollar amounts scale automatically with the account. You don't change your risk percentage as the account grows. The percentage stays constant. The dollar amount follows. This is why the same trader who was excellent at $500,000 can be excellent at $5 million. The decisions don't change. The scale does. And scale requires no new skill. It requires the same discipline applied to larger numbers. The risk framework. Why the math only works if you protect it. The compounding models in segment 2 assume something that is not automatically true, that the trading account survives long enough for the compounding to work. Most accounts don't, not because the strategies are wrong, because the risk management is absent, inconsistent, or overridden at the worst possible moments. Here is the risk architecture that makes the $200,000 weekly strategy mathematically sustainable over years and decades rather than spectacular for 3 months and then gone. The 1% rule. Why it is not conservative? It is structural. At 1% risk per trade on a $5 million account, you can lose 100 consecutive trades and still have $1,840,000 left. A 63% drawdown. Catastrophic, but survivable. The account still exists. The compounding engine can still restart. At 5% risk per trade, 50 consecutive losses. A realistic worst-case scenario for most strategies leaves you with $73,000 from a $5 million start. A 98.5% drawdown, non-survivable in any practical sense. The difference between 1% and 5% risk per trade is not a 5 times difference in outcomes. On the downside, it is the difference between survival and destruction. On the upside, because win rates and return ratios provide the asymmetry, the 1% risk trader reaches the same destination with significantly less volatility in the journey. Maximum daily and weekly drawdown limits. Every serious trading operation, whether individual trader or institutional desk, has defined maximum loss thresholds that trigger a mandatory stop. A common framework at the institutional level. If daily losses exceed 2% of account value, trading stops for the remainder of the day. If weekly losses exceed 4%, trading stops for the remainder of the week, and a strategic review is conducted. These are not suggestions. They are hard stops, non-negotiable, built into the system before the week begins. The purpose is not just capital preservation. It is psychological protection. The most dangerous trading state is not ignorance. It is the recovery mindset after a significant loss. The trader who has lost $80,000 on a Tuesday and is trying to recover it by Friday is not executing strategy. They are executing ego. And ego in live markets is among the most expensive states a human being can occupy. The hard stop removes the option to revenge trade. The option being gone means the decision was never made. and the account survives to compound another week. Correlation risk, the hidden threat at high capital levels. As position sizes grow, a risk emerges that small account traders rarely encounter. Correlation, multiple positions that seem independent but move together in stress scenarios. A trader long EUR/USD, long GBP/USD, and long AUD/USD is not in three separate trades. They are in three highly correlated expressions of the same thesis, US dollar weakness. If that thesis is wrong, all three positions lose simultaneously. The effective risk is not 1% per trade, it is 3% on a single directional bet. Elite strategies at this level track total directional exposure by currency, not just position by position. The entire book is evaluated for correlated risk before any new position is added. This is the level of risk management sophistication that separates accounts that survive and scale from accounts that perform brilliantly until one correlated event unwinds everything simultaneously. The scaling pathway, from where you are to where this strategy lives. Let's make this concrete and personal. You are not managing $5 million today. Most people watching this video are not, but the $200,000 weekly strategy is not a destination that exists in isolation from where you currently are. It is the far end of a continuum that you are already on, or can be on, if you understand the stages between here and there. Stage 1. Proof of concept, $500 to $10,000. This stage is about one thing and one thing only, proving that your strategy works in live market conditions with real money on the line. Not backtesting, not demo trading, real money, small enough that losses are not catastrophic, large enough that they are real. At this stage, the target is not returns. The target is consistency. 30 trades documented, 60 trades documented, win rate confirmed, risk to reward ratio confirmed, emotional response to drawdowns assessed and managed. You are not building wealth at this stage. You are building evidence. Stage 2, system validation, $10,000 to $100,000. The strategy is proven. Now it is scaled, carefully, systematically, not aggressively. Position sizes increase with the account. The risk percentage stays constant. The journal continues. The review process becomes more sophisticated. At this stage, prop firm capital becomes available as an accelerant. A trader with documented performance from stage 1 has something that prop firms want: evidence of edge. A funded account of $50,000 to $200,000 supplements personal capital and accelerates the timeline toward stage 3. Stage 3, institutional bridge, $100,000 to $1 million. The strategy is now generating meaningful absolute dollar returns. Monthly returns in the $5,000 to $50,000 range are attracting attention. Performance fees from managed accounts begin to represent a significant income stream independent of personal trading profits. The psychological work at this stage is different from the earlier stages. The numbers are large enough to create emotional interference in both directions: fear of losing what has been built and greed accelerating the timeline. Both require active management. The same discipline that built $100,000 from $10,000 builds $1 million from $100,000, not more aggression, the same discipline. Stage 4, professional operation, $1 million and beyond. The trader is now operating at professional scale. Personal capital, prop firm capital, and managed client capital are all components of the overall strategy. The $200,000 weekly target is within mathematical reach. The strategy is institutionalized, not dependent on any single insight or emotional state, but built into rules, risk parameters, and review processes that execute independently of how the trader feels on any given day. This stage is not the end. It is the beginning of a different kind of problem: scale management, team building, regulatory considerations, infrastructure, but those are good problems, the kind that replace bad ones permanently. The variables most traders ignore that determine everything. The math of this strategy is not complicated. The variables that determine whether any individual actually executes it successfully are not mathematical at all. They are human. Variable 1. The relationship with drawdowns. Every strategy at every capital level will produce losing periods, extended ones, periods where the account is below its previous high by 10%, 15%, 20%. How a trader responds to those periods determines whether the compounding model survives. The traders who made it have a documented process for drawdowns. They reduce size. They review the strategy. They do not change the core framework mid-drawdown. They continue executing valid setups at reduced size until the strategy's natural win rate reasserts itself. Then they scale back up. The traders who failed in drawdowns made one of two errors. They stopped trading entirely, missing the recovery, or they increased size to accelerate recovery. Both responses extended the drawdown and in many cases ended the account. Variable 2. The relationship with winning periods. Winning periods are as dangerous as losing periods. A sequence of profitable weeks creates a specific psychological state, overconfidence, that relaxes the risk parameters that the profitable sequence was built on. This is where strategy destruction most often happens. Not in the drawdowns, in the winning streaks. The trader who has made $80,000 in 3 consecutive weeks feels invincible. The stop loss that would have been honored at $10,000 in profit gets moved at $80,000 because surely this trade will also work. The position size that was carefully calculated gets increased because the recent performance seems to justify it. And the market, which has no memory of recent performance, corrects the position exactly as it would have corrected it at any other time. Variable 3. The review process every week. No exceptions. Total P&L, win rate for the period, average win versus average loss, comparison to strategy historical parameters, assessment of any rule violations and their outcomes, identification of market conditions, the strategy navigated well or poorly. This process is not optional. It is the feedback mechanism that keeps the strategy current, honest, and improving. The traders operating at $200,000 weekly are not operating the same strategy they had at $10,000. The core principles are the same. The refinement is a decade of weekly reviews. The journal is the asset. The trades fund the journal. The journal improves the trades.